everybody. Brian Lockett here with another market update from Comprehensive Wealth Management. Today, I want to talk about the tug of war that's going on in the markets. We're going to go through each one of these categories, but really quickly going around the horn, what we can see here is we're seeing some economic improvement. We're seeing, as a result, positive market performance, but it is fading. The tug of war side, the other side of this is that valuations are extreme. Investor behavior, everyone's on one side of the trade, that being stocks. And we have this little thing you've heard us talk about in the past, an inverted yield curve, which so far what I've found is that's preceded at least every single recession without exception since 1970. So this is definitely something that we have to give a lot of weighting to. If I were to look at the economic seasons, I would describe us as in the slowdown phase. We've peaked. I would say that was probably during COVID and all of the stimulus. And we're on the other side of that hill. We're reining in all of that stimulus. And we've raised interest rates because of the inflation. And this is really putting a squeeze on everything. So if I had to guess, this is where we're at, which means likely recession's next. But that doesn't mean it's tomorrow. It could be a while from now. So I really want to present two sides of the coin here. We have the tug of war. We have the case for recession, and then I'm going to take you through the case for no recession. And then we're going to wrap a bow around it. Where does all of this send us? How should we position our portfolios in response to this information? So first of all, market valuations. They're extreme, and they're some of the most extreme we've ever seen. I'm not going to spend a ton of time on this chart. You've heard us talk about this before. Basically, what we're looking at is size of the stock market versus the size of the economy. The long-term average of this relationship is 0.91, meaning the stock market has been about 9% smaller than the economy on average since November 1979. You understand, this is just one factor. So this isn't the end-all be-all, but what it does tell us is if markets are expensive, fairly valued, or cheap, and right now at 1.89, the stock market is 89% larger than the economy. Again, it's 9% smaller on average. So this tells us, in general, stocks are expensive. On top of that, other valuation metrics, you can pretty much see that with the exception of one, the equity risk premium for AAA rated corporate bond yields versus the S&P 500, the stock market is expensive. In fact, I've never seen it this expensive across the board. And as you guys know, expensive things are dangerous. At least that's one of our mantras because there's less upside and more downside potential. I mentioned earlier that we have this inverted yield curve, the canary in the coal mine. We've talked about this so many times over the years. It's interesting how it keeps resurfacing. Basically, what you'll see here is every time the red or blue line goes below the black line, that's an inversion, which means that the shorter term interest rates, in this case, we're looking at the 2-year Treasury interest rate versus the 10-year and the 3-month versus the 10-year. Both of those right now, I'm getting paid more on the shorter term stuff than I am the 10-year, and that makes no sense. If I lend the government money for the next 10 years, I'm going to get paid less per year than if I were to lend it for the next 2 years or even just the next 90 days. Every single time this has happened, since at least 1970, this has resulted in a recession, those gray bars you see there. So this is definitely something that we got to give a lot of weighting to. And so until this is no longer a predictor or a precursor to recessions, we definitely have to give this some serious consideration. I mentioned this in the last video. We've continued to see the leading economic indicators drop. So this is a set of statistics or economic factors that have a tendency to explain the direction of the economy. Are we in an expansion cycle or a contraction cycle? And what we've seen is a 23-month consecutive decline in these. Now, we're going to go through a case for no recession. They are improving, meaning they're not dropping as fast anymore. But until they reverse course, this is definitely something we also have to give weighting to. I would say not many people are talking about this right now, but one of the reasons that we saw corporate earnings so high during COVID is because interest rates were so low, and interest expense is an expense to corporations. Lower interest expense, higher revenue or higher profits, excuse me. So here we are. We've seen a massive rise in interest rates. And so this is cutting into the bottom line of some companies. Now, we're not going to talk about this too much today, but there's talk about a K-shaped recovery. Those companies that were able to lock in those low rates for a long time aren't really feeling this interest rate expense, so they should prosper. But the other side, those companies that weren't able to and now are having to refinance into this at higher rates or had already floating rates are definitely going to feel this. So this could be another dent in the earnings. In addition to this, we have a lot of corporate debt maturing. We've talked about this for several years, the corporate debt maturity debt wall. Is that right? How to say that? Corporate debt maturity wall. That's it right there. So in 2024, we've got just over $1.1 trillion in corporate debt that's maturing. When that debt's maturing, they have to pay it off or they've got to refinance it. Well, I'm going to guess they probably don't have that kind of cash sitting around, which means they're refinancing at a higher rate. That is going to cut into earnings, lower stock prices. Why we would think that's a case for recession. And you can see that this is going to be a pretty big issue now between now and 2028 for corporations. Now let's talk about the consumer. So corporations are starting to get squeezed by the interest rates. So is the consumer. And what you're looking at here is basically total credit card debt versus the consumer savings rate. During COVID, we had a massive spike in the savings rate because we were locked up and sent a bunch of money through all the expanded stimulus programs. And then we saw a massive decline as the economy opened up and we got the inflation, which was the result of printing $5.5 trillion and sending it directly to people's bank accounts. And so people are filling this credit gap or this spending gap, with high interest rate credit. We're looking at credit card rates around 28% on average, and we have about $1.35 trillion in total credit card debt. This is a real problem. Now, it's not going to manifest overnight. It's probably going to be more of those slow squeezes, and we are starting to see that take way. You're seeing credit card delinquencies on the rise. In addition, we are seeing auto loan delinquencies on the rise. And it doesn't look like there's any relief in sight. Last year, we saw finally the Fed pause for 3 consecutive times. And the last pause was in November, and the market just shot out of a cannon. Both stocks and bonds rallied big time on the expectation we were going to see 5, 6, maybe 7 rate cuts this year. Well, all of a sudden, this little uptick we have in inflation, 2 of the last 3 prints we've had, it's looking like we may not see any rate cuts this year now. So it'll be very interesting to see. But that relief that everyone was banking on with respect to lower interest rates doesn't look like we're going to get. And it's because the Federal Reserve is scared of repeating history. This is what happened in the 70s. We had the oil embargo. Inflation goes through the roof because of the higher energy prices. They raise interest rates. They eventually, think they've slayed the inflation dragon. The market starts, inflation starts to drop off, only to surge even higher in the late 70s. This is when Paul Volcker was chairman of the Fed. He pushed prime rate to 21.5% to snuff that inflation. To put that in perspective, today we're at 8.5%. So we do not want to go to 21.5%. The Fed knows the damage that would be done at 21.5%. So really the thought right now is they're just going to hold these rates higher for longer, which is just going to continue to put a squeeze on spending because less spending should curb inflation. Something that no one's really talking about yet, I'm sure this will be a huge headline maybe 6 months or a year from now, and that is I'm just going to call them the Trump tax cuts that were put in place in 2017 are set to expire at the end of 2025. So starting in 2026, the government is expecting to see about a $3 trillion hit in total spending. That $3 trillion in collective tax savings that everyone was benefiting from that was being spent on goods and services and pushing earnings higher is now going to be going to the government, which arguably is probably needed given that we have a $34.5 trillion national debt now, and we're adding $1 trillion to that every 100 days. So I personally don't think this is going to go away. I think they're going to let this expire, and we're going to go to the higher tax rates because the government needs the money. So real estate crisis in China. You've heard us talk about for years all the ghost cities and stuff that the Chinese government was doing. I think they were inspired by the Field of Dreams. If you build it, they will come. Well, it turns out that's not true. And so no one bought these structures, and the developers were carrying that debt and have absolutely collapsed. We've seen their real estate market drop 81% here just in the last 2 years. Unprecedented. On top of that, now what we've seen is a stock market in China, which was booming this let's just say century. Well, it is completely back to where it was in 1997 now. So this is definitely something we want to pay attention to, because China has been a major factor in GDP growth globally. Their booming economy was really, really felt worldwide. But now what we're seeing is their GDP growth has really slowed down. They're transitioning into maybe more of a developed nation from that standpoint. These are GDP numbers still higher than the US, but these are more like what you would see with a developed country versus a developing country. And the bigger issue here is China, despite all the inflation we're experiencing, is actually dealing with deflation, prices going down. And that's just because people can't afford them. And so historically, when China has gone into a deflationary cycle, the world has gone into a recession. But understand, this sample size isn't huge. We're only going really back to 2000. But again, it's just another part of the case for recession. So now let's get into the case for no recession. What if we get that soft landing the Federal Reserve's talking about? What is the supporting documentation for that? The bright spots is that manufacturing is climbing out of the hole it was in for a while there. Reading above 50 is in expansion territory. And services looked like they were going to go into contraction territory, but they have rebounded and they're going into expansion territory as well. So this is good, because normally you see a lot of layoffs when these things go into contraction territory. And not just here, but overseas, we're actually seeing other countries climbing out of the doldrums. And I think this is really the shock and awe, if you want to call it that, of the 2022 rate hiking cycle. In 2022, it was the fastest rate hiking cycle by the Federal Reserve ever. So the shock to the system was incredible, especially when we're coming off of rates at essentially zero. We went from 0 to 5.25% on the Fed funds rate in a year? I mean, the shock is unbelievable. Now, we as consumers don't feel that near as much as companies that are living a very levered company. We have right now 9 million jobs available. Now, I don't have a slide for it in here, but there are a ton of people, baby boomers, that are hitting that retirement age and retiring. And there just aren't enough people behind them that have the skills and training. So we have this big labor shortage right now. So this should support unemployment. This should keep it nice and low. Unemployment is nice and low right now, and we are seeing a lot of liquidity with the banks. But this is tightening. This is something we want to pay attention to. But the Fed, when they raised interest rates and they're reining in the M2 money supply to curb this inflation, that kind of caused the banks to seize up. That's why we saw a lot of those bank failures in 2022. So the Fed decided, all right, we need to backstop this. We need to provide some liquidity to these banks. We don't want rushes on banks as well. And so they provide that liquidity, but they are reversing that. And that's because the inflation resurgence we've seen, they're thinking, oh, maybe a little bit too loose. We need to tighten this up. And we are seeing some relief in interest rates overseas. Not here at home, obviously, but I do expect eventually we will see that. Now, the positive news here is that, we're still in the pause cycle, and it could be a while. We're going to talk about that in a second. But normally, when you get, stocks have benefited when rate cuts don't cause a recession in the following 12 months. So if that's the case, we get that first Fed rate cut and no recession. That's really positive for stocks, and it's good for bonds. If we do get that first Fed rate cut and then we still go into a recession, it's historically bad for stocks, but still good for bonds. Now, everyone got crazy about the fact the Fed paused, for the third time last January. So we were everyone was banking on an average here of 10.5 months. So the last hike was July of last year, which put May of this year being the first rate cut. Well, it doesn't look like we're going to get that. And again, we probably won't see any rate cuts this year. So we're probably looking at maybe the 14.5 months from the last hike, or maybe even the longer period of time, 18 months from the last hike to the first cut. So that's when relief would show up from the higher interest rate environment we're seeing. So what do we do about this? How do we position for this real tug of war situation we have going on in the marketplace right now? Well, first of all, we have to recognize where we're at. So when you look at valuation, stocks are extremely expensive. Treasuries are reasonable. And so looking at the Shiller price to earnings ratio, you're looking at a long-term average of 17, going back to 1870, But right now we're sitting at 35 times earnings under this metric. And the reason we care about that is that historically, when the Schiller price to earnings ratio is above 27, and again, we're at 35, the average return over the next 10 years for the S&P 500. So if I bought it today and held it for the next 10 years, I would expect to make on average 2% per year. That'd be my annualized return. What that likely means is that there's probably a pretty big drawdown in there at some point, which is killing your average. As we said earlier, expensive things are dangerous. There's a lot more room to fall than there is to rise. So at this point, even if we get a soft landing, stocks still don't look attractive because they're so expensive. On the other hand, bonds actually do look more attractive. We think we can get similar or better returns in the stock market in the current environment based purely on this metric right here. So looking at the 10-year annualized return of the Treasury bond, if we have a starting yield in the 4 to 5% range, we can expect to make about 3.5% per year over that 10 years versus the just less than 2% on average for the S&P 500. So the return profile looks actually a lot more attractive for bonds. Now, this is not a long-term play. I don't want you to think, oh my gosh, we're going to be parking in bonds forever. But in the short to medium term, depending on how long things play out here, it looks like Treasury or bonds in general, Treasury bonds, actually look like the more attractive opportunity. And historically, inverted yield curves have been good for bonds. I like to compare it to the 2000 scenario here because we had similar interest rates. And so what you can see here is we had similar starting interest rates. And you can look 24 months out. Here's what your overall return was, for instance, for the 10-year. And 5 years out, you're looking at 29%. So decent, not too bad. Not exciting, but it sure beats what's likely the big drop in there at some point. And bonds historically provide some protection in recessions because you get that flight to safety. The stock market sells off, investors flee to bonds. The nice thing about bonds today, they're actually yielding something. It's been forever since we've seen yields like this, really pre-housing crash that we actually saw Treasury bonds paying in the 4 to 5% range. So the value propositions there, they're attractive. So we think those dollars leaving the stock market will make their way into the bond market, driving the value of the bonds that we're already in up. That is the big expectation here. In our mind, the question is really more when. And historically, when Treasury bonds have a bad year, they have a tendency to have a really good year afterward. So you can see here, for instance, 2009, this is the second year of the housing crash. Bonds dropped, basically everything dropped that year. And then you had a good year in 10, 11, and a little decent year in 12. 13, down 9, up 10 the next year. 1994, down 8, up 23 the next year. So you typically will see a big bounce back. And what I find really interesting is since 1928, so 94 years, you're looking at 2022 being the single worst year for the 10-year Treasury bond. So I think that we're probably going to see a pretty nice snapback rally at some point in Treasuries as well. And what we really like is the math. Sometimes it's fun when the math really, is in your favor. And that's what we're seeing here. So what this is showing is what would be the impact if interest rates were to rise or fall 1%? And so just looking at the 10-year Treasury bond, if they went up 1%, so that'd be everything to the left, we would expect to lose 3.8%. Manageable. But if they were to cut rates by 1%, we would see about a 12% return. So the risk-reward ratio here is fantastic. So first of all, I just want to state, I don't expect the Fed to raise interest rates another 1%. I think they're going to hold and then eventually cut. But if they raise interest rates by 1%, the stock market will likely have a massive tantrum. So a 3.8% drop will likely pale in comparison to what we would see if we were heavy in the stock market at that time. Now, I just took you guys through a ton of information and I went through it very quickly. If you guys want to discuss this more, please give us a call. We're always happy to help at Comprehensive Wealth Management. Thank you.